Hey guys, Joseph Henson here with Henson CPA Group, and I wanted to talk today with you about something I had a few people ask me when I've been talking with them. They said, "Hey, I don't know how to read my financial statements. It's not my job. I really don't care to know, but every now and then I have questions." So today we're actually going to talk about how to read your veterinary clinic's financial statements like a pro. Again, I'm Joseph Henson with Henson CPA Group. And the first thing we're going to discuss is why financial literacy matters for veterinary clinics. It does a lot of things. It will provide financial clarity and it will lead to better decisions. Many clinics struggle due to mismanaged finances and not from a lack of clients. And then it'll also lead to how understanding your numbers will help you grow. So first up, let's go through the 3 essential financial statements. I'm just going to give you the names. We'll go through a little bit of thing after that. So the first one we wanted to talk about is the profit and loss or the income statement. Next, we're going to touch on the balance sheet. And after that, we're going to talk about the cash flow statement. I want to make something clear. We're going to give you a little bit of an overview, 10,000 foot view. I could talk about each of these for 30 to 40 minutes, get into different types of projections you can do with them, ratios, KPIs, your key performance indicators, a lot of stuff. I can't do this in 10 to 15 minutes. So as always, if you're like, hey, I really want to hear more about profit and loss, let me know. I'll give you guys my email address at the end of this. Email me and say, I really want to know more about this portion. So understanding your profit and loss statement. What is the profit and loss statement, and what does the profit and loss statement do? It will show you your profitability. It will show you the revenue sources by appointments, by procedures, by boarding, by products, by any sort of surgery, that goes into your procedures. It will give you a lot of that if you have a good set of numbers. Now, some of the key cost categories are going to be your cost of goods sold, your COGS, your operating expenses, payroll, rent, just typical overhead. Now, this will get you to a net profit, which is your total revenue less all of your expenses. So this will be your revenue sources and your cost of goods less all the other expenses. Some key metrics in your profit and loss statement are going to be your gross profit margin. Revenue minus cost of goods sold divided by revenue multiplied by 100. The net profit margin will be your net profit divided by revenue multiplied again by 100. We're trying to get you to a percentage. And then your revenue per DVM, how much each doctor is generating. Very important to know what each doctor is generating. If you're paying one of your associates $300,000 a year, I'm throwing a huge number out, and they're only bringing in $500,000 a year, hey, great, except you have other costs that go into that. At that revenue, hey, they're netting you $200K, phenomenal, except for the fact that it takes 2.5 staff members to support them. Plus, if they have health insurance, if they have vacation time, if they have any sort of disability insurance through you, it all adds up. What you see their salary as is not typically what it actually costs you. Expense ratios, there's a lot. Payroll, rent, and supply costs, these should all be balanced as a certain percentage of total revenue and of total expenses. Understanding the balance sheet. What does the balance sheet do? Well, the balance sheet measures financial health of your clinic. It is comprised of your assets, your liabilities, and your equity. So it starts with the assets, your cash or cash equivalents, your accounts receivable, and any equipment or asset you have on the books. Liabilities, this is going to be loans, this is going to be credit cards, accounts payable. So what are accounts payable? This could be payroll payable that you have right here, but you don't pay it, or they haven't cashed a check if you have people who are still doing checks and not direct deposit. This could be any sort of sales tax. Those are payables until they're done. So those areas. And then the equity, this is your clinic's retained earnings. It is comprised of a number of items. It can be net income, prior year retained earnings that were not distributed to the owners. It can be owner distributions, and it can be owners' contributions into the clinic. What did you give the company that wasn't a loan, but an actual cash inflow that you are going to later recoup? Some key balance sheet ratios that you should be looking at with your accountant. The current ratio, what is your liquidity? It's going to be current assets, so cash and cash equivalents divided by current liabilities, anything due within less than 12 months. You want to have current assets of 1.5 plus. So if you have $150,000 in current assets and $100,000 in liabilities, that means you are running at an efficiency level that you have enough assets on hand to cover anything coming up in the next 30, 60, 90, 120 days. Your debt to equity ratio. This is going to measure financial leverage. How much debt is in your company versus what do you have in the retained earnings? So I'm going to go back here and kind of point out debt, liabilities, equity, your clinic's retained earnings. Your days cash on hand. This is going to be about how long your clinic can survive on reserves. If you run every month and you have $20,000 worth of expenses and nothing else, just $20,000, and you have $100,000 in cash in the bank, how many days of cash do you have on hand? You would have 5 months. And so you're saying, hey, if I had to stop operations today, but keep all these expenses going, it's not how operations work. That's okay. Let's say you get hurt and you're trying to make sure you're paying your employees, you're paying electricity, all this stuff. But how long can you last before this becomes an emergency? The more, the better, while also making sure you don't just have dead cash on hand that isn't doing work for you. Your cash flow statement. This is the one a lot of folks don't look at, and it's because they don't really understand it. Yeah, I don't understand when my veterinarian says, hey, your dog has this issue. Okay, cool. What do I need to do with that? That's just what it is. So what does the cash flow statement do? It will track your money movement. What's coming in, what's going out, what's operational, what is going to be investment expenses, a number of items. The common cash flow pitfalls that we've seen are going to be the slow invoice collections. You have invoicing out there for 45, 60, 90, 120 days. You're not collecting. A lot of that's bad debt. A lot of it's also coming down to high inventory holding costs. If you have too much inventory on hand and you're not able to move it out fast enough, you're going to have spoilage. You're going to have a lot of waste going into that doesn't work well. Now, what are some strategies to improve your cash flow? Optimize payment collections. Look at Care Credit, look at Scratch Pay, look at a number of these items that will allow you to no longer just have pay or receivables on the books. Receivables are hard because you have to have someone dedicated to trying to collect that a lot of times. And if someone doesn't have the ability to pay it on that day, a lot of times they're hard, especially if they don't have a credit card. My philosophy is a lot of times, hey, if you're unable to get approved for a Care Credit card, I don't want to take that risk either. And it just makes sense. You don't want to have risk out there that even a credit card company won't take on. You need to monitor your operating expenses. This is going to be anything that it takes to run your clinic operationally. Any sort of cost of goods, that's above the line anyway, but rent, utilities, payroll, these are things that go into the operating the clinic. And then you have to understand this, and this is where a lot of people get. Your net profit doesn't always mean positive cash flow. Again, if you only hear one thing, net profit does not always mean positive cash flow. But Joseph, I had $100,000 in cash in net income at the end of the year. Why do I have $20,000 in my bank? Dude, just because net profit was there doesn't mean you had things that weren't being hit in other areas. These all work together. If you have an income statement, you have a balance sheet. And a lot of items that you're hitting on the income statement are not always going to be reflected there, because sometimes, like if you have a loan, a portion of that's income statement, a portion of that is balance sheet. You pay $1,000, but $200 goes to interest. The interest expense, the interest that you're going to see on your income statement should be $200, and that liability is going to be reduced by $800. That's where the biggest confusion gets to. I understand that it's extremely complicated. Owner draws, if you're taking money out that isn't related to payroll, those are not income statement accounts. And so a third time, net profit doesn't always mean positive cash flow. One of the things you need to do with your clinic is benchmark your financials against industry standards. What does that mean? You need to compare your revenue, your profit, and your expenses to industry standards. You want to do this within a clinic that's roughly the same size. If you're a $500,000 clinic and growing, don't compare yourself to a $10 million clinic. It doesn't work. You want to compare apples to apples. If you're a clinic that's in the middle of a really busy city, you're going to be making different revenue than one who's in the country. You're going to have different things. You're not seeing the cows, you're not seeing the horses, most likely. You're seeing more cats, dogs, and those kind of things. Identify areas for cost cutting or revenue growth. A lot of times, folks want to focus on cut. Well, I want to make money. I need to cut. You can only cut so far. At some point, you do have to focus on, hey, I just need to make more revenue growth. Maybe that means hiring another doctor. Maybe that means adding a service or cutting back on a service. If doing spay and neuters isn't making you money, but the other surgeries are, maybe you're focusing on those and sending the spay and neuters to a low-cost spay and neuter clinic. Those are options. Maybe that's boarding. If you're spending $50,000 a year on boarding expenses, maybe $75,000 worth of revenue isn't worth the headache and the expenses. Those are just some of the things you want to look at. Well, that is all I have for you today, guys. I appreciate you taking the time to watch this and giving me feedback on the things that don't make sense and things that do make sense. Again, I'm Joseph Henson. You can see my email right on the screen, joseph@hensoncpagroup.com, 2 E's in Joseph. And you can see our website and get a hold of us through that. Also with www.hensoncpagroup.com. Don't know why wrestling's on the mind, but it was.